Ind AS 12 Income Taxes. Revision Material for GAI. Introduction. Ind AS 12 Income Taxes is a critical accounting standard that provides guidance on the accounting treatment of income taxes, including the recognition, measurement, presentation, and disclosure of current and deferred taxes. Understanding this standard is crucial for aspiring chartered accountants as it is widely applicable across industries. This revision material covers key questions that will help tackle questions related to IND AS 12, conceptual questions and answers 1. What is the objective of IND AS 12? To prescribe the accounting treatment for income taxes, including the recognition of current and deferred tax liabilities and assets. The standard aims to ensure that an entity recognizes the tax consequences of transactions in the same period in which they are recognized in the financial statements. 2. How does IND AS 12 define current tax and deferred tax? Current tax, the amount of income tax payable, recoverable for the current period based on taxable income loss, calculated using tax rates and laws enacted or substantively enacted by the reporting date. Deferred tax, the tax consequences of temporary differences between the carrying amount of assets, liabilities, and their tax base, which will result in taxable or deductible amounts in future periods. 3. What is the difference between taxable temporary differences and deductible temporary differences? Taxable temporary differences, differences that will result in taxable amounts in the future when the carrying amount of the asset or liability is recovered or settled, lead to DTL. Examples include depreciation on fixed assets where tax depreciation differs from accounting depreciation. Deductible temporary differences, differences that will result in deductible amounts in the future, lead to DTA. Examples include provisions that are recognized in financial statements but are deductible for tax purposes in future years. 4. How is deferred tax asset DTA and deferred tax liability DTL recognized? DTA recognized to the extent that future taxable profit is probable against which the deductible temporary differences can be utilized. DTL recognized for all taxable temporary differences unless specific exemptions apply, such as those arising from the initial recognition of goodwill. 5. Explain the recognition criteria for deferred tax assets with examples. Deferred tax assets are recognized if there is convincing evidence that sufficient future taxable profit will be available to utilize the deductible temporary differences. For example, unused tax losses carried forward can be recognized if future profits are expected from upcoming business expansions or contracts. 6. What is the impact of carry forward of unused tax losses and credits? They are recognized as DTA if future taxable profit is probable. However, the entity must reassess at each reporting period and de-recognize if recovery is no longer probable. 7. How does IND AS 12 treat temporary differences arising from business combinations? Deferred tax is recognized on fair value adjustments except for goodwill arising from a business combination. Example, if an asset is revalued during acquisition, the deferred tax liability is recognized based on the fair value uplift. 8. What is the treatment of deferred tax for revaluation of assets? Deferred tax is recognized in equity or OCI when related to revaluation gains/losses. For instance, revaluation of property, plant, and equipment leads to a deferred tax liability recognized in OCI 9. How are deferred taxes presented in the financial statements? Deferred tax assets and liabilities are presented as non-current items in the balance sheet and classified separately from current tax assets liabilities. They cannot be offset unless the entity has a legal right to do so. 10. How do you measure deferred tax assets and liabilities? Using the tax rates that are expected to apply in the period when the asset is realized or liability settled, based on tax laws that have been enacted or substantively enacted by the reporting date. Practical application questions and answers. 11. How does IND AS 12 handle changes in tax rates and laws? Deferred tax is adjusted in the period of change based on the new tax rate law and reflected in the profit and loss account, except when related to items recognized in OCI 12. Can deferred tax assets be recognized if the company has a history of losses? Yes, but only if there is convincing evidence supporting future taxable profits, such as secured long-term contracts, restructuring plans, or profitability trends. 13. How do you account for deferred tax when an asset is measured at fair value under Ind AS 109? Deferred tax is recognized based on the fair value adjustment affecting taxable profits, such as fair value changes in financial instruments classified under fair value through profit or loss, FVTPL. 14. Explain the treatment of deferred tax for items recognized outside profit and loss, OCI or equity. Deferred tax related to items in OCI or equity should be recognized in OCI or equity respectively, ensuring alignment with the recognition principle. 15. How is deferred tax calculated for lease liabilities under Ind AS 116? Deferred tax is recognized on the difference between the carrying amount of lease assets and lease liabilities, which arise due to the different accounting and tax treatment of leases. 16. How should deferred tax be accounted for in case of uncertain tax positions? A provision is recognized if it is probable that the tax authority will not accept the tax treatment, considering a range of possible outcomes and applying the most likely amount or expected value approach. 17. What disclosures are required under Ind AS 12? Entities must disclose the components of tax expense, reconciliation of effective tax rate to applicable tax rate, movements in DTA/DTL, and unrecognized DTA details. 18. How does Ind AS 12 interact with Ind AS 115, revenue, and Ind AS 116, leases? It considers the tax effects of revenue recognition, timing, and lease liabilities assets, such as deferring tax liabilities when revenue recognition is deferred. 19. Can deferred tax be created on goodwill arising from a business combination? No, deferred tax is not recognized on goodwill unless it arises from deductible temporary differences, such as tax-deductible goodwill amortization in certain jurisdictions. 20. Explain the concept of initial recognition exemption in Ind AS 12. No deferred tax is recognized on initial recognition of an asset liability that does not affect taxable profit or accounting profit, such as an interest-free loan recognized at fair value. Conclusion. Mastering the concepts of Ind AS 12 is crucial for CF freshers preparing for interviews. A clear understanding of current and deferred tax principles, practical applications, and disclosure requirements can help you demonstrate strong technical acumen during job interviews. Stay updated with changes in tax laws and continue practicing with real-world scenarios to enhance your expertise.